Paul Cavey, thanks very much indeed for joining us.
Give the government some confidence. Think about the economy more broadly going well for China. The more interesting story is you look at TSMC.
I'm Paul Cavey. I run a company called East Asia Econ, doing macro analysis on the big economies of East Asia. So Japan, China, Korea, and Taiwan. I'm doing it for 25 years or so in different companies. And now I'm doing independent research based in Taipei. So you might have seen recently, there's been all of these headlines around Japanification, right? Like this issue that's facing China. And the reason for this, one of the headlines that came out was because Japanese yields fell below Chinese yields. And so that's been, obviously the story for the course of the last 25 years, where interest rates in Japan just fall and end up near zero. Now you have a situation where Japanese yields are up a bit. I mean, they're still not very high, but Chinese yields are now falling very, very quickly. And the 10-year yield in China getting down to around 1.5, 1.6%. Like, this is sort of like the market saying that it believes economic growth in China will only be around 2% over the course of the next 10 years. So this is quite a big thing, right? And so it's very easy to see why people then say, well, this is China following Japan. Interest rates are a leading indicator about where the economy is going. It's what investors price in about where they think economic growth is going to go. So this suggests that China is following the Japanese malaise. And if you remember, Japan had a great economic story up until about 1989, and then it stopped. And for the course of the last 25 to 30 years, there's been hardly any growth in Japan at all. So if that's the fate that's facing China, it's obviously very important for investors. And it's actually very important for the global economy because China was such a big engine of growth up until around 2015 or thereabouts. So that's one of the issues I want to talk about today. And I think one of the interesting things about this comparison between China and Japan is if you think about the way that research is structured in Asia, and if you think about expertise in Asia, it tends to be very specific. There's a bunch of people who look at China and they're specialists because China is a complicated, big place that people spend their whole careers looking at, right? It takes a long time to learn Chinese. It takes a long time to try to study what's happening in the Chinese economy. On the other hand, you have a bunch of people in Japan who have a very similar experience. If you think about how Asia research used to be structured, it was all Asia ex-Japan. Japan was a thing on its own. It wasn't an economy being recovered at the same time as you looked at Korea or you looked at China or you looked at Indonesia. It was very much thought of something being on its own. And as a result, you have a bunch of people who look at Japan who don't necessarily know about what's happening in the rest of the region and certainly don't have a huge expertise about what's happening in China. So if you think about a Venn diagram, you have a circle over here of people looking at Japan and a circle over here of people looking at China. And there's a very small window sort of in between where there's some people who might look at both. Now, the problem is when you think about Japanification, there are not that many people who can really speak about this issue. And I remember a few months ago, I went to this conference from a big investment bank. And there was an economist there. This was in China, in the mainland. There was an economist there, their Japanese economist there to go and talk about Japan in the context of where China currently is. And he's a great economist. I used to speak to him, listen to what he was saying when I was on the buy side. And at that point, he still knows a great deal about Japan. He's a very good resource. But as he himself said, he doesn't really know very much about China because it is a whole separate thing. So there's this whole debate about Japanification, but it's actually quite difficult to get people who know about both sides of the story. Now, so how do I come into that? How can we think about this? Well, I think it is quite useful now because the Bank of Japan, and again, this is probably something that a lot of China experts don't know so much about, but the Bank of Japan at the end of December published a very long report looking at the experience of Japan over the course of the last 25 years. Now, this was part of Governor Ueda, who came into office a few months ago. It was sort of his pet project of reviewing where monetary policy in Japan currently is. And it was very much focused on monetary policy. But it does give us a very nice sort of roadmap, a tick list, if you like, of things we can be looking at to say, is China following the same path as Japan? And one of the interesting things coming about that report, it's a very good report, very interesting, quite long, but well worth reading. But one of the things that comes out about it is Japan is just very idiosyncratic. There is some stuff that you can look at and say, well, China today may be following that same Japanese model, but a lot of it is actually very specific, a very specific set of circumstances related to both Japan and related to the world economy that Japan faced in the 1980s and the 1990s that caused Japan to have the economic malaise that it then suffered. So trying to generalize that and say China is following the same route actually starts to look a bit like it's not really a very good representation of where China is. And so specifically, that's what I want to do today. I'm going to use this report from the Bank of Japan as a checklist where we can tick off where China currently is today. In that report, the Bank of Japan basically splits the factors that cause Japan's problems into three big boxes. The first is demand side issues. So as they say, a chronic shortage of aggregate demand in the economy. The second thing is supply side issues. And so that's going to be something about competitiveness and the way that companies work. That was the second group of things that the Bank of Japan identified. And the third thing is a bit more cultural, a bit idiosyncratic. Now, if you take those three buckets of things together, you come up with a list of basically 15 different points. So broadly speaking, there were 15 things that we can identify that caused the problems in Japan back in the day. Now, if you look at where China is today, it actually ticks very few of those boxes. And if you take those, 15 different points, give each mark from 2 where China is exactly or very similar to Japan back in the 1990s, to a 0 where it's very different indeed, you end up with a score of about, a maximum score of 30. On my estimation, China is only at a score of 10. So in fact, it's only really scoring a pass point of 30% on this scorecard of whether it's going to be like Japan. So the point is, the conclusion from all of this is that actually China is not similar to Japan at all. There's some things which look similar, there's some things to worry about, but it's unlikely that China is following the path that Japan followed. What's the market implication of that? One of the things is that interest rates in China probably are far too low, and that yields and bond yields in China are unlikely to fall much further. So that's what I want to talk about. And I'm going to try and talk about it in 2 parts. So as I said, there's these 3 buckets of things. The demand side issues are a bit longer, so I'm going to focus on those today. And in a couple of weeks, we'll come back and talk about the second set of issues, which is the supply side stuff and some of the idiosyncratic things around Japan. So maybe to start with, think about the demand side stuff. Where was the demand side stuff similar to what was happening in Japan and China? So the first point that the Bank of Japan makes is that what was the starting point for a lot of this? It was the bursting of the asset price bubble, so the bursting of the bubble. And so if you look at property prices, equity prices in Japan, but in specifically property market prices, they all peaked in 1989 and then they really collapsed thereafter. So it took 30 years for the equity market prices in Japan to get back to the levels where they were in 1989. That barrier was only broken a couple of years ago, right? It took for ages to get back. And if you look at property prices, they're nowhere near. So property prices fell from 70 to 80% from the peak in cities like Tokyo. So this was a collapse in activity, a collapse in important asset markets in Japan. Now, where does China fall in that? Well, equity markets are terrible, but often they are in China. I'm not sure we can read a huge amount into that. But where there is significance and where there's similarity is in property. So property prices, the data's a bit skewy in China. It's a bit difficult to know exactly what's happened with property prices. But when we do look at the official data, we certainly get a good idea that property market activity has come down a lot. So things like property starts, property sales, these are all down by 60% from the peaks back in 2021 before the Chinese government came out with this policy called the three grade lines, which was designed to control developer debt. So that there's some similarities here, right? If we take the first point, asset market collapse, what's happened with property prices, what's happened with some of these important markets, there's a big tick next to China. It looks quite similar to Japan. So that's the first point on the demand side. The second point then is the feed through of that into the rest of the economy. So the second point from this is that that the Bank of Japan makes is this then falls into a tightening of lending standards. And why does that happen? Because banks lent a lot of money to the real estate market. The real estate market collapses, prices come down. The value of the assets that the banks lent based on those asset values come down. And so the banks become much more reluctant to lend anymore. And again, this is something that was very apparent in Japan. I mean, it took a long time for the government to sort of wake up to this and do something about it. But the Bank of Japan has a quarterly Tankan survey. It looks at the company's estimation of how easy it is to get money from the banks. And this estimation of ease of getting money from the banks collapsed during the course of the 1990s. So it clearly showed there was a big tightening of financial conditions in the economy. Now, for China today, there's nothing quite like that. If we look at the performance of banks on the equity market, there's not that much difference between Japan back in the day and China today. So the banks trading below 1 times book, like obviously a lot of speculation about how bad the balance sheets of the banks are. Like there's some similarities here. However, when we look at lending standards, the data that we do have doesn't actually suggest there's been a huge amount of tightening in China. So there's a survey from one of the universities in Beijing. It suggests that financial conditions, again, as registered by companies, doesn't suggest like actually there's been much change over the course of the last 6 to 7 years or so. If we look at the PBC's quarterly survey of banks, which unfortunately, and this is a bit of a red flag for China, but this hasn't been published over the course of the last 6 months or so, at least until the middle of last year, was also showing that there didn't look like there was a big tightening of credit standards in China. So I think at best, when we do a scoring of this, the problems in the banking sector and the feed through of those banking sector problems into the economy, at best, this is probably just a scoring of 1. So it's not quite, it's not we can't call that this is China is okay in this respect, but it doesn't look like it's nearly as serious as Japan was. So the third point, why does that fall back in bank lending standards? Why does that matter for the economy? Because if a bank isn't lending money, then a company can't go and invest. And obviously, if a company can't invest, then the economy is going to slow down. Now, again, if you look at Japan back in the 1990s, there was very clear evidence of this. So as lending standards tightened, you saw that the investment in the economy started to contract. That was true in the manufacturing sector and was also true in the services sector. So this tightening of lending standards had a clear feed through into the rest of the economy. Now, when you look at China, it's really not so clear that that's going on at all. Certainly in the real estate sector, that's true. And obviously, and again, like why did these problems in China emerge in the first place? It was the 3 red lines in 2021 that was designed to control developer debt. As a result, the banks have stopped lending nearly so much to the real estate sector. Mortgage lending growth has slowed down a lot. Like there's a clear sign of a change towards real estate and property sector lending in China. However, when you look at the rest of the economy, so if you look at the manufacturing sector, if you look at the services sector outside of real estate, there's not only no evidence of that, there's actually evidence that manufacturing investment in particular has actually accelerated massively since 2021. So lending from the PBC numbers themselves show that lending by banks to manufacturing companies has picked up a lot. And if we look at the fixed asset investment numbers from China, they also show that there isn't really any sign of investment in manufacturing coming down. It remains very robust. So yes, there's a problem with real estate, but it doesn't look like the feed through from bank lending standards to investment in the economy is nearly as pronounced as it was back in Japan in the 1990s. So I think on our checklist, we can say that this is something that isn't happening. China doesn't get a score here. The next thing, so lending standards tighten, investment starts to come down. Again, what's the next thing that follows from that? And this is probably the way that most people think about Japan back in the 1990s and how we should think about China today. The thing that happens next is that companies start to save. So this isn't what should happen in an economy, right? When you think about how an economy works, it's generally speaking that households and people save money. Companies go and spend that money by borrowing from banks. So when you look at the national accounts in an economy, you tend to have this situation where the household sector is a net saver, the corporate sector is a net borrower. And that's what makes the economy work. Now, what we saw in Japan during the course of the 1990s is this changed. So households remain savers, but corporates move from being net borrowers to being net savers. And this is probably, again, the way that people think about Japan back in the 1990s. And this is the so-called balance sheet recession that's made very famous by Richard Koo, who's been back in China in recent months and saying this is what's happening in China today. Now, again, the problem is that there's no evidence of that in China. So we don't have data, admittedly, from 2023. We only have data up to 2022. But it shows that the net lending deficit of the corporate sector is still enormous, above 10% of GDP and getting bigger. So there's not only no sign of it contracting and becoming savings, it's actually showing that the corporate sector is running up even bigger debts than it was before. So there's not this sign that companies are withdrawing. There's no sign that the banks are lending them less. And there's no sign that corporates are using that and saying, well, okay, then we need to start to save money instead of borrowing and investing. So again, this is not something where you can say that China is following the same path of Japan, at least not yet. The next point, like where does this leave us in terms of aggregate demand? The next point is in terms of this means that productivity growth slows in the economy because you're getting less accumulation of physical capital. And again, this is the point about investment. So when you look at the investment side in Japan, investment fell during the course of the 1990s. And that's one of the reasons why the economy stopped growing. Now, again, we look at the data in China, it's very different between different sectors of the economy, and real estate looks pretty bad. But looking at the manufacturing sector, if anything, manufacturing investment continues to pick up strongly. So this idea that you're going to have there's a shortage of aggregate demand, which is the point that the Bank of Japan is trying to make, was one of the big reasons why the economy had troubles. The shortage of aggregate demand comes from the corporate sector not spending any money anymore. Again, that's not really apparent in China in any of the data that we really look at. Now, why are we sort of so interested in investment, and why does investment matter so much in the economy? Obviously, because it's companies going out and spending on machinery, and they build factories and they employ people. So obviously it matters in that sense. But the other reason it's important is because investment is what drives productivity, and productivity is what gives you growth on a sort of sustainable long-term basis in an economy. And so the other thing that happened in Japan, as companies began to become net savers, as they became more cautious about spending money on anything, they also dropped investment in things like R&D in terms of human capital. So these things that drive productivity going forward, these things also started to slow in Japan. Now, if we take R&D spending in China as an example of this, of an illustration of this, there's again no sign of this happening. So R&D spending in China as a percentage of GDP on the most recent data continues to pick up. It continues to rise. There's no change in the trend over the course of the last 10 to 15 years or so. So again, if you're wanting to say that China is following Japan's footsteps, you have to sort of give evidence for that. And looking at what happened in Japan, the R&D spending and the investment in productivity, again, that sort of thing is just not evident in China that it's following the same path that Japan took back in the 1990s. Now, there's just two more things to think about here in terms of this demand side buckets, so like trying to think about where China is today. So the first of those things is this, and the Bank of Japan puts it very explicitly, that in the 1990s, Japan was left behind by the global trend of globalization and the IT revolution. And if you want sort of the poster child for that, obviously it's something like Sony. I'm staring at a Sony camera here in this studio. But if you think about it, like the big companies of Japan, Sony, Hitachi, like Toshiba, the big electronics companies in the 1990s grew very strongly until about 1995, and then they just stopped growing. And obviously, Sony was the make when I was a kid. It was the company that you aspired to buy a product of back in the UK, and this company stopped growing after the 1990s. And so do you have that in China today, where this, globalization and the IT revolution, is this really something that you can say that China is not riding the wave, when we've just had DeepSeek making such a big splash over the course of the last few months in terms of AI, where you look around and see how strong Chinese exports are and how strong Chinese exports of electric vehicles and of electronics in general. You see the Bank of Japan, the Bank of Korea complaining, or getting nervous because Chinese companies are beginning to increase their market share of the global memory market for chips. All of these things, there's plenty of evidence that China is actually still remaining very competitive. So I think this idea that was clear in Japan, that in a society where it's difficult to keep up with the IT revolution, clearly that has a big impact if you have very big electronics firms. In China, again, we can't tick this box. It looks very different. Now, the final point in this demand side bucket is about demographics. And if you want one area where you can say China really is following the same path, it really is this. So this is something where China scores a 2, looks exactly like Japan, if not worse. Marriage rate, a lot of you would have seen the data over the course of the last couple of weeks or so, where the marriage rate in China has fallen again. The birth rate is falling. The population is aging. Like the absolute number of people in the population is also falling. So all of these things are going on. Like there's very little in this to differentiate China from Japan back in the 1990s. And ultimately, this is going to matter for the economy, right? You can see it very clearly in Japan today, even in terms of data released this week, where the GDP numbers on Monday were actually were okay. But one of the weaknesses in the GDP numbers is consumption is weak. Consumption was weak in Japan in large part because the number of people in Japan is now falling. So these things do matter for the economy. So you take this list of demand side stuff in China and think about where China is relative to the path that Japan followed back in the 1990s. It really doesn't look very similar. It's not adding up. It's not saying that China is following the path that Japan had back in the 1990s. And so when you read all of this speculation in the market and the media about Japanification, that this is justifying interest rates in China being very low because it's following the same path of Japan, if you take the first big bucket of issues that caused Japan's problems, that bucket of issues suggests that actually China looks very different. So just to summarize where we are with this demand side. So I've gone through 7 different issues which we can identify as causing Japan's problems. So that's asset markets bubbles burst, financial system instability, tighter lending standards, firms become net savers. That results in lower investment and productivity. The country gets left behind by this kind of global tide of globalization and IT, and finally demographics. Now, if you take all of those things, I reckon we can give China a score with 2 for asset prices bubbles, so definitely ticks that box. For demographics, it also ticks that box. For everything else, it's either not the same or only very sort of similar, but really quite a weak comparison. So I think overall of this score of sort of 14, if you like, for the maximum that we might amount for China to get. In fact, in all of this, it only really gets something like a 5 or thereabouts. So it's not following the path in terms of demand. So that's what we talked about in the first part of this kind of analysis of China today compared with Japan 20 years ago. The next time I'm going to come back and talk about it again, but from a different angle. And that's to look at the second bucket of issues that the Bank of Japan focuses on, what's happening with the supply side, and second, what's happening with some of the more idiosyncratic things, which is sort of institutionally how the Japanese and Chinese economies work. So we'll come back in 2 more weeks and talk about that again.